Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. Lots of interesting things to go through, as there often are. Volatility in the stock markets, some movements in the commodities. Also want to go through any stock codes you'd like me to have a look at. Have a look at the charts for those, get those ready for the end of the segment. And I've also got an ETF I want to show you for a major market that's breaking out. I'll do that a bit later in the show, but I think you're going to find it really interesting. As always, everything today, general commentary only. Having been through all of that, let's get straight into that first chart for the week. So we're going to start with the ASX 200, and this is shaping up. This is shaping up as a really interesting period. Is this all part of a big topping phase? Or is it just a pause in the upward trend? And we've got some clues from another market. It's not the US market, it's a different market. I'll show you that a little bit later on. But let's start by looking at what's going on here with the ASX 200. And first of all, I'm going to start with a bearish scenario. So could this be a topping pattern? And I think for those who like their classic chart patterns, you've probably already spotted the developing head and shoulders formation. So this is where we've got a shoulder over here on the left, we've got the head, and then we've got the right shoulder developing over here currently. And the way it works with the right shoulder forms when there's not enough buying power to push prices up to new highs. And then selling interest comes in and overwhelms what's there on the buy side, and that forces prices down. And so just drawing in how that may look on a chart, and that's where you can get a breakdown occurring. So that's how a head and shoulders pattern would work. That's how you get a breakdown. And just looking at that, so there was a sign that interest in buying the dip was weakening in December. So in December we had prices come down, broke below the November low, and that was a sign that potentially that some of the buying interest may have been weakening, and it also broke this sequence of rising lows. As I said last week, that in itself doesn't signal a trend change, but it is a sign that buyers are less enthusiastic about buying the dip. The lows that we had in January are firming up as being, I think that low's firming up as being a key level. If the ASX 200 falls back below there, then the chart structure weakens, and we start then looking at the December low. And below there, below the December low, well then you get the breakdown. That's when you get that head and shoulders type scenario, which I was speaking about. Now, I'm a bit more optimistic. The bearish scenario is only a possibility. It's only a possibility. It may not play out. The point of mentioning it is that I think we should always be aware of what could go wrong. So then if we do that, then we're better placed to manage the situation should prices break down, because we're aware of what could happen. We can then have strategies in place. My bias in these situations is to default to the incumbent trend. And right here and now, I think the trend still remains to the upside. The moving averages remain positive. I've got the 50 and the 100-day moving averages, and the ASX 200 is generally holding above those moving averages. In my view, I think the overall structure here continues to be bullish until we get a clear breakdown. And just remember, the market doesn't have to go down or up straight away. It can also travel sideways, and that's a possibility that I was discussing last week. It could be a case that we get more sideways chop, like we could get the market going sideways, maybe for several weeks, or could even be several months before then prices then move to higher levels. And this is very much where wide trailing stops come into play, because they help us see off periods of consolidation, which we're currently getting in the ASX 200. Now, another part of the market I want to have a look at is the financials, the financial stocks, because this is, of course, a key component of the local market. And the thing with the financials is these have been trending higher for pretty much the last year, a bit over a year in fact. They broke higher in December 2023, been trending higher throughout that period. And prices have come back to the moving averages over the last several weeks. And at this stage, it appears that dip's being bought, dip's being supported. Strong move off there a couple of days ago. And there've been three notable pullbacks, similar to what we're experiencing now over the last year. And you can see them just on the chart back in April, August, and then also in October. And on each of those occasions, prices found support, dip was bought, and then we got rallies off those lows. I think the odds favour that we get a similar scenario playing out this time. Of course, it may be different. Prices can, of course, also break down, but I think the odds do favour the continuation of that price action we've been seeing previously. I think a break below this week's low, that would then be an early sign that the buyers are stepping back and that the trend is weakening. But until then, as I've said, I think the odds favour the uptrend. So coming back briefly to the ASX 200. So I'm working on the basis that this overall trend remains up until proven otherwise. I'm happy to keep holding stocks that remain an uptrend, and I'll manage them with those wide trailing stops, which I often tell you about. But I do think there's still a degree of vulnerability with the current setup. I don't think we should ignore the warnings, some of the warning signs that we have. But all the same, we also don't want to be jumping at every time we see a shadow, which is quite often when you're dealing with these markets. They just don't go up in a straight line. I'm continuing to play this from the bullish side, but I am just using a bit of extra caution, and that same caution I've been telling about for the last few weeks. And now, if you're getting some value from this, please hit that like button. Please leave a short message. Just, hey, thanks for the video. It tells YouTube you're watching. YouTube shows other people, and that helps me heaps. So please do those things. Now, I'm going to jump to the US market in a moment. I've also got the local small caps, the US small caps, commodities, as well as a major market ETF that I think could present a big opportunity and also a big surprise for a lot of people. Now, let's go to the S&P 500. Now, this is really interesting. You might remember that I spoke about this coiling pattern last week, and I said that this type of pattern, when it's near the moving averages, when prices start to coil into this tight range near the moving averages, that it often breaks to the upside. Well, that didn't happen. Last Friday, they started to break to the downside. On Monday, we got a bit of follow through selling from that. But now here's the really interesting bit. This, what looked like was going to be a breakdown, the breakdown didn't stick, and instead prices have quickly reversed and are now back up in towards the midpoint of the range. So that's what we call a false break. So I think the rejection of the breakdown shows that the dips are still being bought. And when a market breaks to the downside and can't sell off, that's often a sign that the path of least resistance does remain to the upside. Just looking at the structure of this chart, the moving averages are still positive. I've got the 50 and the 100-day moving averages as I typically have. So the moving averages remain positive. Price is near those moving averages. And the previous times the S&P 500 has been in this type of position over the last year, that being in April, August and September, buying of the dip has quickly come in, and that appears, at this stage at least, that appears to be what's happening now. I think Monday's low remains a key level. If the S&P 500 is going to, if the S&P 500 comes back and retests Monday's low and then breaks below it, then I think that weakens the structure and likely leads to lower levels. So I think this is really going to be I think this really is going to test the resolve of the bulls. What happens in this period just following this week's low? Can the bulls get the price action moving? Can they get the momentum moving and take the S&P up to new highs at a time when the broader market has been weakening? I'll show you what I mean by when I say the broader market has been weakening. We'll go over to the S&P 500 on an equal weighted basis. So this is where, of course, the bigger stock and the smaller stock has the same weighting. And while the S&P 500 has been resilient, the same can't be said for the equal weight. The equal weight has been under pressure over the last 4 or 5 weeks. Especially with prices consolidating below these moving averages, which, as you can see, is starting to roll over. And so this has been a weakening structure for the equal weight. I think the encouraging development this week has been that prices have rallied. They tried breaking down earlier this week, just like the S&P 500, but now they've since rallied quite strongly in the last few days. So what this does, this disengages the vulnerability of this previous consolidation below the moving averages. Another thing to note is that it's still a situation where over half of the stocks in the S&P 500 are trading below their 100-day moving average. So this tells us the underlying health of the market does remain questionable. And these cross currents, these inconsistencies we're getting in the current trend. So when we look at the S&P 500, we come back to the main S&P 500. How do you manage your portfolio when you have these conflicting signals? Well, look, as I was saying with the ASX 200, my preference is to side with the incumbent trend. And the incumbent trend in the S&P 500 does remain to the upside. We have some warning signs that shouldn't be ignored, but until there's a clear breakdown, which we currently don't have, until we have that, I think the trend remains up. For me, this means staying long, but I have scaled back some of my risk. I'll also stay open-minded. I'll increase or decrease my exposure according to the price action that we see over the days and the coming weeks. And I think this is a really important point. I think people with rigid views about what will happen, and we hear this all the time, people talk about strong conviction. I believe this is going to happen. The market's going to do this. It's going to do that. I think if you approach the market with rigid views, I think the people who do that, they often do poorly over time. So don't bring your ego to the market. It's not about being 100% right. I think it's about backing off when the situation is less clear, like it currently is, and then pushing harder when everything lines up. And that's often when prices they've got that momentum, we've got markets above moving averages. That's when things line up. Not quite where we are at the moment. For now, I think it's a case of a little extra caution and just watching how this develops. Now, I want to show you an ETF for a market that could offer a big opportunity. It's breaking out now, and I think it's going to surprise a lot of people. I've also got the US small caps, the Aussie small caps, the commodities, and of course, any stock codes that you'd like me to look at. I've got them. We'll look at those. We'll look at all those next. But of course, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that. Come in. I think you'll get a whole lot of interesting information and ideas for the small amount of money it costs to make all this happen, to help with the production and the time and everything that's involved with putting this together. Okay, so let's start I'm going to start with where I think there's an emerging opportunity.